Hello and welcome. I'm Alex Proimos, Head of Institutional Content and Investment Magazine, and this is Market Narratives. This show is a series of unorthodox conversations with thought leaders influencing the world of fiduciary investors. For more related insights and analysis, please remember to check out our website, investmentmagazine.com.au, and subscribe for a free email. And with that, please enjoy this week's episode. My guest today is Darren Wills, Managing Director, APAC, Head of Fixed Income, iShares and Institutional Index at Blackrock. So Darren, I thought the first question we should kick off with today is to talk about the evolution of the bond market, specifically from the time of the GFC, where we're now 12 years past since then. A lot's happened. I wanted to get your understanding of what's changed and some background on what we're seeing in the bond market today.
Absolutely. So I think there's a couple of key themes to cover here. So even before the global financial crisis in 2008, 2009, growth in the corporate bond markets globally was outstripping GDP growth. So corporate bond financing as a proportion of corporate financing was already growing strongly. What we saw during the global financial crisis in the period directly after that was as banks delevered post-crisis, corporate bond financing accelerated as a substitute for bank lending, especially for non-financial firms. So if you look at the overall size of the corporate bond markets at the moment, broadly speaking, the amount of index eligible corporate debt in the US corporate bond market has doubled since the global financial crisis to about 7.5 trillion. In Europe, we've seen similar figures in terms of the growth, albeit from a lower base, about a doubling since the onset of the financial crisis to around 2.75 trillion. So that's really the picture in the corporate bond market. It's a shift from bank financing to financing in the public debt markets as bank lending retrenched during that deleveraging period post-financial crisis.
So more specifically about the sort of issuers that we're seeing, are we seeing a broader base of issuers or just larger issuance from a number of key companies?
So alongside growth in the overall size of the markets, as we just mentioned, we've also seen an associated growth in the number of issuers as well as the total number of bonds outstanding. So again, thinking back to that post-crisis period, in the US market, we've probably seen a 30 to 40% in the diversity of the issuer base. So we're looking at 1,200 issuers from where previously we had about 800. And in the Euro market, similar concept. So in the European market, we're now at over 700 issuers in terms of broad European indices from about 400 in that post-crisis period. And then from a diversification of risk perspective, very similar theme. So the concentration of names within that index has also reduced correspondingly during that period. So in the US, the top 10 issuers post-crisis was probably around 19 to 20%. That's gone down to about 13%. Again, very similar figures in the European market. Those top 10 issuers were at about 17% and have moved down to about 13%. I think the also interesting thing to mention is also a shift from the top issuers being concentrated in financial services firms. And if we think back to why that was, and we think about the leverage that banks had pre-financial crisis and then that deleveraging period post-financial crisis, we've also seen a material shift in terms of the makeup and the concentration in the indices from financial firms to non-financial firms.
It's interesting you say that, and obviously for financial firms, the access to bond markets has got a lot easier for them. And there's also a lot of demand for these types of issuance just because there's lower and lower interest rates. So the ability to take advantage of the bond market and these opportunities has become one of the easiest ways to find some returns in this space. Do you feel that given that interest rates have gone lower, that the amount of issuance that you'll see in this space will increase or always likely to decrease?
I mean, I think the two are linked to some degree. So the fact that all types of financial investors have been essentially forced to move out in the risk spectrum to actually generate some income or to generate additional yield in their portfolios has led to a greater demand for corporate debt generally. On the flip side of that, corporates are not going to issue if they don't have financing needs. So it's a combination of the two. So on one side, you see greater demand from investors for corporate debt. On the flip side, as we mentioned earlier, the reduction in bank financing has meant that increasingly corporates are using the public debt markets to access that same bond financing.
Is it fair then to say that, given the need for fixed interest style products for these portfolios, that you're seeing potentially lower liquidity as people are buying and holding these assets?
I think generally no. So I think, as the fixed income markets have developed, and as a greater range of investors have moved into the corporate bond space, and as we're seeing in terms of the modernisation of the bond market, we've seen that the way that financial firms actually trade and price fixed income securities, then generally speaking, I would say that greater investor base with more investors looking at that segment of the market means that there's generally more transparency, there's more flow going backwards and forwards. So I wouldn't say that that's necessarily corresponded with a drop in liquidity. I think one of the things that we saw coming out of the financial crisis, and again, thinking back to that pre-crisis market was characterized by a greater risk-taking capacity, larger balance sheets for risk warehousing, and lower funding and capital costs for banks. Post-crisis, regulatory oversight was enhanced, balance sheet capacity was significantly reduced due to those regulatory changes and funding and capital costs increasing. And banks' operating models are rationalized accordingly. So banks and broker-dealers shifted away from a primarily principal-based trading to more of a hybrid model consisting of both principal and agency trading, with an increased reliance on electronic trading and all-to-all platforms.
Yeah, look, it's an interesting piece. Why I was asking the question is that there is issuance out there, but there are some key bonds that people want to hold, and so it was just a matter of whether you're seeing a lower trading or a lower trading volume. There's still liquidity there, but there's a lower trading volume because people are choosing to hold on to these securities for longer.
And again, I would say that generally speaking, and again, there are some nuances between different markets, but generally what we've seen in the trading and liquidity environment post the financial crisis is, and again, due to that change in liquidity model between that proprietary trading and that more all-to-all or algorithmic or electronic trading, is actually the breadth of trading has increased while the average ticket size has actually reduced. So what we've seen is there's a greater number of issuers in the market, there's a greater number of bonds in the market, but when investors are shifting risk around in the fixed income markets, they're tending to trade a number of line items. So where previously they may have moved risks with a more concentrated portfolio of large single line items, the immediacy of risk transfer due to that change in liquidity model has reduced. So we increasingly see investors using, larger lists of bonds of smaller sizes to be able to shift risk effectively.
I'm curious, when you think about some of these larger investors, are they doing the individual bond trading more and more? Are you seeing that happen, or are they choosing to buy an ETF effectively as the way to get access much more quickly?
I think it's a mixture of both. So I think, and again, if you look back to probably pre-crisis, opportunities to invest in fixed income securities were really limited to all but the very sophisticated investors. The emergence of ETFs amongst other index vehicles has changed that and brought some democracy to the fixed income market. Now, this works in a number of different ways. So first of all, investors who would have traditionally only had the ability to access fixed income through perhaps purchasing an active mutual fund, and then the active mutual fund manager would have done the asset allocation within the fixed income market for them by allocating between different parts of the market, are able to effectively do that themselves. So whether that's global insurers, whether that's central banks, whether that's official institutions or multi-asset funds, they now have the ability to allocate between different parts of the fixed income market using precision instruments such as fixed income ETFs. And on the flip side of that, even within active mutual fund managers' portfolios, they are now able to access different parts of the fixed income market, which they might not necessarily have the in-house expertise to do. So accessing parts of the market which haven't been part of their traditional benchmarks, such as high yield or emerging markets, are increasingly parts of the market like onshore China, ETFs are giving them ability to do that within their traditional portfolios without necessarily having to build out the in-house capability, the trading function, fundamental analysts, where they might have had to do that before.
I'm curious, we've got now this development of ETFs that are coming into this market. You're almost democratizing this over-the-counter market. What impact have ETFs had on the underlying market?
The ETF wrapper has essentially taken a largely off-exchange, OTC-driven asset class. And it's democratized both the access to those parts of the bond market, but also price discovery. And really, it's those two things that I'd point to in terms of that democratization or modernization that we talk about. Really, price transparency underpins the efficiency and fairness of all financial markets. Transparent markets promote more efficient and cost-effective trading. They promote high levels of investor confidence and participation. So again, even when, in my former role, I was managing underlying fixed income portfolios, when investors look to see where a particular market is trading, previously they would have relied on quotes directly from market makers or banks to get some kind of indication of what was going on in underlying fixed income markets, or they would have used synthetic instruments such as CDS indices to actually get a gauge of what was happening from a credit risk or rates risk perspective. Move forward to where we see things currently, and all types of investors, and again, whether that's institutional investors, whether that's retail investors, whether that's fixed income bond buyers, are using fixed income ETFs to get a gauge of what is going on in the underlying bond market. And if you know where risk is being transferred, it gives you greater confidence when you actually come to move risk in that market.
So, when we talk about the ETF market, you've alluded to it a little bit now that there are some very unique parts of the ETF. There's not just one general ETF. There's some quite sector-specific types of ETFs, different types of investment grade, high yield, emerging markets. Are you seeing different impacts in terms of the structure of the market in these different parts of the market due to the ETF development?
I think one of the key characteristics of the ETF is the fact that you're taking essentially an index fund and you're wrapping it in an ETF and allowing investors to trade it on the exchange. And one of the main advantages of that is if investors are all looking at the same beta instrument for a particular part of the market, then you get a lot of different types of investors doing things at different times. So you may have retail investors trading, you may have institutional investors trading, and you may have banks and market makers using ETFs to manage their overall risk on their balance sheet, and versus other beta type instruments such as TRS, such as CDS indices and futures. So once you get that greater volume going on at the wrapper level, what you tend to find is that investors can meet at that wrapper level and transfer risk without necessarily having to trade the underlying bond market. And what that means is that if investors can meet at that wrapper level and transfer risk without having to buy or sell bonds, then what that's going to happen is that it's going to cause a narrowing of transaction costs and spreads compared to what you would typically experience on the underlying market. So one of the key advantages of the ETF wrapper in itself, and just to use an example of high yield, for example, if you look at European or dollar high yield markets, the bid-ask spread on the underlying tends to be around 40 or 50 basis points based on my experience. But at the wrapper level, investors can actually substantially reduce their transaction costs by transferring risk in these products, and bid-ask spreads can be as tight as a couple of basis points. So really one of the areas where, we talk about that democratization, we talk about that modernization of the bond market, we talk about these instruments being another tool in the toolkit for investors to transfer risk effectively. One of the advantages of the ETF wrapper is that can be done generally a lot cheaper than having to trade the underlying bond market.
You mentioned there about the ability for investors to transfer risk between each other without affecting the underlying. At what point does the underlying start to be affected by flows, in particularly, for example, like the high yield space or the emerging market debt space, where access to these underlying bonds is quite difficult, but the ETF then is quite easy, obviously, to invest in?
So the two are inextricably linked, and they're inextricably linked because the ETF mechanism allows market participants to effectively transfer risk between the underlying bond market and the ETF on a daily basis. So at any time, if the ETF becomes dislocated from where risk is actually transferring on the underlying bond market, then market makers and banks have the opportunity and the incentive to step in to actually arbitrage away that difference between where they can buy and sell the ETF versus where they can actually buy and sell a basket of bonds on the underlying market. So that's the mechanism that really keeps the ETF trading in line with the risk transfer in the underlying market. Now, what we've seen, and not just over the past 6 months, but over the period since the financial crisis, is as fixed income ETFs have increased in size, as more and more investors have started using ETFs to express their view on a variety of different parts of the bond market, that those volumes, those secondary market volumes, those on-exchange volumes have increased relative to the underlying market. So we see actually ETFs and fixed income ETFs in particular to be additive to fixed income market liquidity and to actually take pressure off the underlying market in periods of volatility. Now, having said that, that inextricable link that I was talking about, if you do see directional flow, some of that activity in the end is going to lead to either creations or redemptions feeding through into the underlying bond market, at which point market participants will buy ETF units from investors. And if they can't find the other side of the trade, as an investor looking to buy on the other side, then they will look to cancel those units by selling bonds in the underlying market. So, what I would say, and the key points to mention are, look, the volumes will tell you that secondary to primary market ratio, that ETFs are adding additional liquidity to the markets. But at the same time, we realize that the two are linked. And if there is selling pressure and buying pressure on particular parts of the market, in the end, that is likely to feed through to buying or selling pressure on the underlying bond market.
You mentioned there a little bit about the underlying pressure on the bond market. We can't not talk about the current COVID crisis and the sell down, particularly in March. I'm curious to get your thoughts or some background on what's actually happened in the ETF market, particularly around that period. What specifically did you see? Did we see any potential gapping down in prices during that period?
Yeah, so again, talking about that period in March and, having talked to some of my colleagues who were managing risk in the underlying bond market, I managed fixed income portfolios through the global financial crisis. And that was a pretty extreme period in terms of underlying bond market liquidity. But all the indicators that we have is that the underlying bond market was even worse from a liquidity and functionality perspective than we saw during the global financial crisis. And again, thinking back to what we talked about in terms of that balance sheet, so that ability of financial institutions to warehouse risk, that really wasn't a surprise to me, in the sense that if we saw significant selling pressure across fixed income markets, then those balance sheets were going to get full up pretty quickly, and therefore prices were likely to gap lower and markets were likely to become increasingly dysfunctional. So in terms of ETFs, so one of the things, and again, an advantage I would say from an investor perspective and in terms of the market as a whole, is that ETFs are very transparent. You can see flows going through on ETFs on a daily basis. The data is freely available. And as we discussed, you can see where ETFs are trading at any point during the day, because you can see those thousands of trades going through on an intraday basis. And reporting or trade reporting the underlying bond market is better than it was. So we have Trace in the US, where all bond trades have to be reported on a post-trace basis. MiFID in Europe is helping in terms of those bond trades are reported now, but on a delayed basis. But the ETF really is the only instrument where you get live, up-to-date view of where risk is being transferred in a particular market. So what we saw was outflows starting to happen in the riskier or higher beta parts of the market. So, when we started hearing about the effects of COVID, we started hearing about, shutdowns happening in various economies around the world, then investors looked to take risk off in their portfolios quite naturally. And first of all, that happened in the higher beta parts of the market. So specifically here, I'm talking about investment grade credit, high yield credit, and emerging markets. But actually, it quickly fed through into other parts of the fixed income market. So short duration credit, mortgage-backed securities, and indeed there was significant dislocation even in the US Treasury market, which we usually would look at as the most liquid and deep market in the world. So even in the US Treasury market, people were finding it difficult to know where the off-the-run bonds were pricing, and bid-ask spreads had widened significantly. So ETF flows were effectively a canary in the gold mine in terms of investors realizing where risk was actually being transferred, where underlying markets were actually trading. Now, the flows on ETFs, as we talked about, are transparent, but that doesn't mean that selling pressure isn't happening across all kinds of other financial instruments. I mean, ETFs in themselves, the current number stands at about 1.3 trillion in terms of fixed income ETFs. The fixed income market is over 100 trillion in size. So fixed income ETFs is still a relatively small proportion of the market. Active mutual funds, probably around 12% of the market. And as that data came through, that fund flow data came through on a delayed basis, what we came to realize is that outflows were happening across all parts of the fixed income market. And actually, outflows from active mutual funds and other index funds dwarfed what was happening on ETFs themselves. So we're really seeing broad selling pressure and broad de-risking across all parts of the fixed income market, not just limited to ETFs.
Do you have any empirical data on what maybe drives some of that repricing or that dislocation? Is it the underlying that's maybe moving faster and then repricing with the ETF, or the ETF fund flow is then ultimately having an impact on the underlying?
I think ETFs tend to lead the market because they're more transparent, and that's where risk is being transferred. So again, if you look back at that period in March, and we saw that selling pressure coming through and those prices gapping downwards in the ETF space, then that tend to happen faster than those NAV marks or index marks that are used to price the NAV of both the ETF and the rest of the bond mutual fund market. So the ETF was being priced on a live basis, and effectively that was giving a leading indicator of where certain bonds were trading in the underlying market and where risk was being transferred between investors. Now, NAV marks or index marks, and we have to understand that there are thousands of underlying line items in the bond markets. Just to take an example, the global aggregate has 25,000 line items. Even the US corporate bond market has 8,000 to 9,000 line items. Many of those won't trade on a daily basis. Many of those won't even trade on a monthly basis. So index providers and fund administrators will try and work out where they think those NAV marks should be using where they can see actual trades going through, and they're making some kind of assumption as to where other bonds may or may not be valued. Again, you look at the ETF, and effectively what market makers, what banks, what investors are doing is pricing that basket risk on a live basis. So to take an example, in the worst part of the volatility and the sell-off that we saw, which was around mid-March, some of our US corporate bond ETFs were trading at about a 5 to 6% discount to their official end of day NAV. And you can make arguments either way about where you see valuations, but the reality is that those ETFs were trading. The underlying bond markets were not trading. If you step forward even 1 or 2 days, those actual discounts to NAV had normalized to some extent. But it was the NAV that had come down to the same level as the ETF had trading at 1 or 2 days previously, not the other way around, in the ETF being mispriced and then reacting back to where those NAV or index prices were.
Let's go into that pricing differential a little bit more, that dislocation. We've had some change in the market in the sense that there isn't as much proprietary trading. Banks don't have that ability to arbitrage as much. We still do have a lot of algorithmic traders that can take advantage of that differential. In these sorts of crisis environments, how do you make sure that arbitrage process still works? Obviously, you mentioned there was a slight differential, but how do you pull those two together in these types of environments?
I mean, look, the first thing to mention is premiums and discounts are a natural function of a market where the underlying has a bid-ask spread. So, even in the period since the financial crisis, we've seen periods where fixed income ETFs have seen significant premiums or discounts versus their end of day NAV. One example I can give you is when the ECB announced their bond buying program, and their corporate bond buying program in particular, coming out of the sovereign debt crisis, is that at that point in time, we saw European high yield and European investment grade ETFs trading at between 2 and 3% premiums to NAV. As investors look to put corporate bond risk on in their portfolios, those prices on the ETFs adjusted higher, and the underlying NAVs and index prices lagged and caught up over time. The same is true of this period. So investors were trading the fixed income ETF at the wrapper level because they found that an easier way to transfer risk and to get liquidity. And they understood that that was giving transparency into where underlying markets were trading. The underlying bond market in itself, as I mentioned earlier, was severely dislocated. It was very hard to transfer risk on a single line item basis. Having said that, the ETF market still functioned as intended, and market makers were still able to buy and sell ETF units and to create and redeem ETFs all throughout that period. The fact that those premiums or discounts remained in place is not necessarily a breakdown of the arbitrage mechanism. It's a breakdown of the index or NAV pricing versus where actually bonds were trading in the market versus where ETFs were trading in the market. So it's important to make that differential.
Mm-hmm. You mentioned a little bit about the bond buying programs that was started. We also saw the same impact of the Fed and Treasury support programs in the US. I wanted to get your comments on how that potentially supported the bond market and indirectly maybe the ETF space as well.
Yeah, so I think firstly, the important thing to make clear, as I do work at Blackrock, is that the mandate that Blackrock has with the Federal Reserve is managed in a completely separate part of the business. It's part of our financial markets advisory function, which sits behind an information barrier. So I'm happy to give my thoughts around the impact of the program, and I certainly will. But just to make it clear that I don't have any additional information regarding the program specifics more than what's been publicly made available by the Federal Reserve. So let's talk about that period. So again, we'd stepped into a world where equity markets were in free fall, where economies were shutting down across the globe, and investors really didn't know how to price risk, right? No one knew how to price risk effectively. So people were de-risking portfolios. And there was a degree of panic in the market. There was a degree of panic in the market in that people, start of all, tried to de-risk their equity portfolios, found out that equities were 30-40% off their highs, then looked around for other parts of the market where they could de-risk their portfolios. We talked about the impact that had on emerging markets, on high yield bonds and corporate bonds. And then investors started to sell anything that they could sell. So that selling pressure went through into all parts of the fixed income market, including short duration corporate bonds. So we found ourselves in a situation where markets were in free fall, and more importantly, the corporate debt markets were not functioning. So, corporates could not finance themselves in the public debt market. So clearly something needed to be done. So what the Fed announced on, I believe, the 23rd of March was an array of programs in conjunction with the Treasury Department that actually went above and beyond what we saw during the financial crisis, most notably unveiling a facility to buy corporate bonds and ETFs tracking that underlying market. Now, one of the things you would see is that in the 7 or so weeks that followed, credit spreads tightened materially across the globe, and we saw actually a record amount of issuance back into the corporate bond markets. And all of that happened without the Fed buying a single corporate bond or a single ETF. So 7 weeks later, they had actually done nothing. And the markets had normalized to some degree, selling pressure had abated, and the corporate bond markets had opened back up to companies financing themselves, which was exactly the impact that I think the Fed wanted to have. And again, the Fed made clear in their public announcements that the facility was intended to support orderly pricing, prevent market dysfunction, and prevent fire sales, not necessarily using the facility for spread suppression. Now, I think this is an important thing to mention because this is a big difference between the Fed's program and the ECB's program. So the ECB have been buying corporate bonds for a number of years now. And actually, the size of their corporate bond buying program dwarfs, in terms of overall size and in terms of a proportion of the underlying corporate bond market, what the Fed is doing. And they're explicitly trying to suppress spreads to make it cheaper for companies to finance themselves, but also to essentially crowd investors out of the lower risk parts of the market and actually help companies finance themselves and actually for investors to move into higher risk parts of the market to help the economy get started post-financial crisis. That's very different from what the Fed had announced. So moving forward, where are we as we currently stand? So as of, I think, the end of July, Fed had bought approximately 9 billion of fixed income ETFs and probably around 4 billion of individual bonds. Put that in context. Year to date, inflows on fixed income ETFs from both iShares and competitors are around 180 billion. And if you look at the impact on the underlying bond markets, a single issuer can easily issue 10 billion in one day. And in fact, we've seen issuance across March and April, running in the 250 to 300 billion range. So again, when you look at the impact that the Fed has had, it's really the rhetoric. It's the confidence it gives to corporate bond investors that there is a buyer of last resort, that the Fed does have the ability to step into the market to support financing for companies and to support the functioning of orderly markets. But that's really, knowing that the Fed is going to be there, I would say, rather than the actual actions of the Fed itself in terms of the volume of ETFs and underlying bonds that they've bought. So, that old adage continues to be true: don't fight the Fed. So that's really the reaction that we've seen since that announcement in mid-March.
I'm curious around the ETF market in the sense that, given that ETFs have democratized the fixed income bond issuer space, has that actually supported more issuance coming to the market because that there is this support through ETFs of late?
Again, I think you could argue that on a marginal basis, based on ETFs being an increased share of overall fixed income bond markets, albeit, as we discussed before, from a very low base. But the reality is, and again, we talked about that number, fixed income ETFs being 1 to 2% of the overall fixed income market, active mutual funds being around 11 to 12%, the rest of the fixed income market being held by a range of other investors, and whether that's central banks, whether that's insurers, whether that's pension funds. So, as ETFs continue to become a greater proportion of the underlying market, then yes, they will help to support and buy issuance directly from corporates. But I would say, based on the relative sizes of the markets, they're not at the moment probably going to be a key driver of whether that issuance gets done or not.
Mm-hmm. The reason I asked the question was that these parts of the market are often, particularly the high yield, it's the marginal buyers and sellers that are moving the market. So my question was around the ETF space specifically, given that it makes access so much easier for investors, that ultimately then it helps flow into providing liquidity to the underlying issuers in that space.
I mean, that's certainly, again, true to a degree. But again, I will point back to the fact that one of the common arguments that you hear from certain market participants is that fixed income ETFs to a degree have encouraged tourists into certain parts of the market where they might have not invested in emerging markets or high yield or other parts of the fixed income market before. We don't really think that to be the case, and the evidence doesn't support that. When investors, whether that is central banks, whether that's insurers, whether that's asset managers, previous to fixed income ETFs being part of the market, part of the market infrastructure, they would have still accessed those markets. They would have just accessed them through different vehicles. Traditionally, they would have accessed them through buying single line items, or they would have accessed them through active mutual funds. So we don't necessarily think that, this has caused a increase in so-called tourist investors. We just think that, alongside those direct bond investments and alongside those investments into active mutual funds, all kinds of investors now have the opportunity to use the fixed income ETF if it so meets their investment objectives in terms of accessing that market. The other thing that I think is, again, important to note is that, certain parts of the market think that, still in some degree think that somehow the fixed income ETF or the ETF wrapper in itself is a retail instrument that's only really used by individual investors who are buying and selling or trying to make money from short-term trades in these various markets. That's simply not the case. So, even where we have the greatest penetration of retail into the fixed income ETF, which is the US, over 50% of that market is still institutional investors. In Europe, actually, the proportion of institutional versus retail is really dominated by institutional investors. So we still think over 80% of that market is institutional in nature. And when you move into the APAC market, that figure is even higher, based on different types of regulatory change. We've seen regulatory change in the US and Europe actually encourage all types of investors to use more index products, to use lower cost products and to move more towards a fee-based advisory model. In Asia Pacific, the retail investor base still tends to be dominated by retrocession or commission-based models, and therefore the incentive to use index or ETF vehicles is still lower. So in APAC, again, the market is really dominated by institutional investors. So again, what does that mean from a flow perspective or pressure, selling or buying pressure on the underlying market? Again, perception would be that if people see or if individual investors see markets going down, that they're going to suddenly rush to the exit. And actually, compound that selling pressure and cause that vicious cycle that has been touted in terms of people seeing selling pressure and then deciding to sell their own investments. Actually, again, what we saw in the recent period of volatility, that it was mostly institutional investors that were adjusting risk in their portfolios and were selling risk. From what we can see is that retail investors were actually relatively stable, and if anything, we're actually looking at the dislocation in the markets to add risk, to actually use it as a good entry point to add risk to their portfolios rather than selling.
All right, that's been a fantastic conversation. Thank you very much for your time today, Darren.
Thanks very much, and thanks for inviting me.
Thank you for joining us. All views expressed on this podcast are subject to change and do not necessarily reflect the views of Connexus Financial. This podcast is for educational purposes only and should not be relied upon as investment advice.